Tom Bowley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Wednesday, May 22nd, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we take a look at yesterday's action and prepare for the day ahead. And speaking of the day ahead, we have Nvidia coming up with earnings after the bell today. That is going to be a report that's going to impact a lot of areas of the market, especially semiconductors. And of course, semiconductors are heavily weighted in both the S&P 500 and especially so in the NASDAQ 100. So there's going to be some potential gains or losses, whichever way you're looking at it, depending on not only how or what Nvidia reports, but how the stock market reacts to it. So that's on deck. That's later today. It's not going to impact today's trading, although it would be interesting to see how Nvidia and maybe some of those semiconductor component stocks do trade into the close today. But really what happens after the close is going to be what's most important. Let's check out the futures this morning. I'll give you those, try to give you those real quick here. We got the diamonds currently down 0.17%. The spider down 0.14%. QQQ, of course, tracking that NASDAQ 100, up 0.03%. And the IWM tracking the small cap Russell 2000, currently down about 1/3 of 1%. So that's a kind of what we saw yesterday, a little bit of bifurcated action. Just seemed like the market was treading water, not really doing anything. But after going up and setting an all-time high, that's not a bad thing. In fact, one of the positives coming out of it is that the volatility index continues to remain low. And after we moved back up into the 12s over the past couple of days, we saw the VIX yesterday drop back down, close at 1186. So if you study history like I have, you know that when the VIX is this low, the market has an overwhelming tendency to move higher. The stock market as a whole, I'm talking about the S&P 500. The volatility index is essentially calculated by taking the premiums on the S&P 500, short-term S&P 500 options to determine the expected volatility over the next 30 days or so. Market makers set those option premiums. So it's basically a sentiment look into, maybe from the market maker perspective. I like to follow the equity only put call ratio, which is a sentiment indicator from more of the retail trader perspective. So I like to use the two in tandem because I think it gives me two really good sentiment readings, but by two different participants in the market. So anyhow, the volatility index, after reaching almost 20 a month ago during that April swoon in stock prices, now we've seen that VIX drop all the way back down into the 11s. We were down around 11.5 recently, I think, or close. No, well, maybe we didn't get down that low. Maybe we were just under 12. But this 1186 close looks to me like the lowest close on the VIX in the last year. So that includes even last year's cyclical bear market. We came out of that and had such a big run in November and December. We saw at that point the VIX get down to about 12. Yesterday's close was actually down below that. So volatility, I think the market makers through the pricing of options are telling us that over the next 30 days, we should not be expecting a whole lot of volatility, which is very good for equity prices. Because as you know, volatility goes up when the stock market goes down. So I think that the signal that's being sent is exactly the signal I would expect to be sent when the S&P 500 and some of the other major indices are setting all-time highs, which is exactly what we've been doing. Anyhow, let's take a look at yesterday's action. We'll start off with the Dow Jones Industrial Average. Let's zero in here. We got the Dow Jones yesterday up 66 points, back up near the 40,000 level. Still haven't been able to close above 40,000 since we did last Friday, but we're so close. I mean, anything could set it off, especially a big report out of Nvidia, or just a return to normalcy by the transports. Transports are heavily represented in the Dow. And transports have been horrible, and I'll show you that chart here in just a second. Moving on to the S&P 500, gain of 13 points yesterday. That was about 0.25%. New all-time high on the close yesterday at 53.21. The NASDAQ 100 rising 40 points yesterday, closing at a new all-time high. Mid caps, not so much. Almost looks like a nice move up in a maybe little flag, maybe a bull flag. And then IWM, same thing. We did rally off of earlier lows, closing near the high, but still down 20 cents on the IWM. But we do have that PPO continuing to move higher. It's a little bit of a cup. I would have liked to have seen the cup get up maybe another dollar. I like to see equal highs, but looks a little bit like a cup. And this recent action to me looks like a handle, or maybe off of this flagpole, maybe sideways consolidation would be your flag. So you got your bull flag there. But here is the problem. And this is honestly an indictment against our economy going forward. I mean, that is another really ugly candle yesterday on the transports. Stock market seems to be ignoring it, at least ignoring that part of the stock market. I don't think it's going to last forever. I mean, I don't expect transports to just keep breaking down and falling to lower lows while the stock market just keeps going up. It kind of is a little counterintuitive. I mean, normally you would expect the stock market to go up because we're expecting good things from the economy down the road, which in turn would have folks buying transports. But, and I've talked about this a lot. I don't want to spend a whole lot of time on it here, but I do want to recognize that isn't just a little bit of a bearish candle. That is an ugly candle. And volume ticked back up a little bit. It wasn't heavy, but it was higher than it was the previous day, and looks like selling all day long. So it's hard to get bullish on transports, at least at this point, given the look at the technical outlook there, or the technical picture. All right, move all the way back over here. Let's go down and take a look at the sectors. Yesterday, utilities, another good day, another breakout, 0.9% to the upside. That is good. Remember, utilities were underperformers for a long, long time. We look at this and we say, we think always with recency bias. And, I spent a lot of time yesterday talking about some of these defensive groups that have been leading somewhat to the upside recently. When you look at it on a relative basis to the S&P 500, though, it almost looks like a dead cat bounce because we've been going down for so long. Many of these defensive groups on a relative basis recently set 5-year relative lows versus the S&P 500. So they don't look that great. But if we only want to consider a month or a month and a half or 2 months, then yeah, you can see that the strength here is pretty obvious. Part of what's going on here with utilities, in my opinion, is the anticipation of lower rates. I mean, we've seen rates coming down, but we're anticipating that rates will go down further. And if you think about the appeal of utilities, a lot of it is their dividend. And so with rates coming back down and projected to go lower, part of this is the fact that income investors are getting in because they can do better. They have more upside, and also getting a really nice dividend in the process. So I think that's the primary reason. I have had some members write in, talk about AI and the fact that utilities are needed to fuel, AI. And I get that, but AI has been going on for a while. Utilities were performing horribly just until the last month or two. So I don't think that's it as much as it is just the fact that rates are coming down. When rates come down, that usually is a good thing for utilities, not necessarily as a leader on a relative basis for the long term, but this group was so beaten down. It was really beaten down badly on a relative basis. So I think we're just seeing some catch up. That's my opinion. But as long as it continues to trade up and it's trending up above its 20-day moving average, which is rising, and above its 50-day moving average, which is rising, I'm fine with it. Just be careful when it starts to move higher and we see a really definitive move lower in the PPO, because I think that could be the signal maybe to the end of its leadership role. Anyhow, financials next. Gaining 27 cents, up about 2/3 of 1%, almost 2/3 of 1%. After a rough day in the financials with JP Morgan, there was a lot of discussion and talk about Jamie Dimon potentially stepping down, saying that there's no longer a 5-year window. It's going to be something less than 5 years. I said yesterday I thought it was an overreaction, an opportunity. We saw the banks bounce back yesterday, and that helped to lift the financials. So part of what you're seeing that there with the XLF is simply a nice rebound in the banking area. Discretionary stocks. Well, we haven't talked about discretionary much as a leader for any days over the course of 2024 this year. But yesterday was one of those days. It also rose just under 0.2%. Nice action. I really would like to see a breakout. I mean, we do have a flagpole. This could be considered more of a flag. Maybe we have a little bit of a triangle, whatever you want to call it. A breakout above 180 on the XLY would be solid. And I think one of the areas to look at is the auto group. Autos had a strong day yesterday. I'll show you that in just a minute. And Tesla is a big part of the XLY. So it's heavily weighted in the XLY. If Tesla continues moving up and we get the autos to keep moving up, I think that could be the catalyst for the XLY finally to make a little bit more of a bullish move here. Renewable energy. I wanted to mention this because obviously it's up 8% yesterday. However, First Solar is heavily represented in this. So when First Solar does well, the renewable energy group usually does well. When First Solar doesn't do well, renewable energy normally doesn't do well. And I'm saying that because First Solar had a good day yesterday, really good day, but many of the other renewables did not. Enphase Energy down. I think I saw Solar Edge was down. So some of the others that have been beaten up so badly over the past year, 2 years, still struggling. So they did not really participate in that big move yesterday in renewable energy. Autos, this is what I was talking about. With Tesla recently, we've seen these gap ups, and that's what caused the gap ups in the autos as well. But we pulled back a little bit lesser volume. It's been, pretty decent volume over the course of the last month or so. But we pulled back, went back to gap support just below these moving averages, and then started to come back up. Yesterday, very strong day. And you can see the volume, while it wasn't as heavy as we've seen recently during the gaps and so forth, we did see the volume pick up. It was the strongest over the last 4 days. Of course, the last 3 days, we've been consolidating in this range. But yesterday, we did break out of the range and the volume did accelerate a bit. So we'll see if we can get back through about 725 or so. If we can on the auto group, it's likely to be because of Tesla. And that in turn could signal a breakout for the XLY. Banks, there are the banks. You saw that big drop yesterday. That was, again, JP Morgan. But we did get a nice rebound yesterday. The group as a whole jumped more than 1.5%. Haven't gotten back to the recent highs, but certainly closer to that now than we are the 20-day moving average, which is a better look. All right, 10-year Treasury yield. So later this morning at 10 a.m., we're going to get the existing home sales out. It's expected basically to be flat versus last month, so we're not expecting any major change. But right now, let me get an update where we stand here. We are up a little bit on the 10-year Treasury yield back to 4.45, kind of up testing these moving averages. I'll kind of zoom in here because I'm watching not only the moving averages, but when you start a downtrend like this, down, back up, down, when you go back up, if you can get back through that prior high, that ends the series of lower lows and lower highs and can signal a return back to the prior high. And that's what I think has spooked stocks in the past, is the threat of rates moving up, continuing to move up. And the way it's getting interesting right now, because what I'm seeing is higher expectation of rate cuts. But when we talk about rate cuts, we're not talking about the 10-year Treasury yield. We're talking about Fed funds, which is a very short-term rate that really is used banks can borrow against the Federal Reserve at that rate. It's going to be more tied to a lot of short-term interest rates, not the 10-year Treasury yield. What would be interesting is if the Fed started cutting rates and the 10-year Treasury yield still stays up where it is, or maybe even moves a little bit higher, what it could be signaling is that the stock market or the bond market is beginning to think that the economy is going to strengthen as a result of those rate cuts. Because I think the reason that the yields have been up in the past has been more inflation protection. It's the inflation expectations. But if the Fed starts cutting, bond market's either telling us it's the economy, or the bond market would be saying the Fed's making a mistake. One of those two, and I guess you can pick your poison, pick your choice. But anyhow, for me, what I'm looking at here on this 10-year Treasury yield is whether or not we can get back through the recent high. I'd really like to see the moving averages hold and then back down we go. I think that would be more of an indication of a downtrend. I think if you move back up, even if you don't get through the 453 area of the prior high, I think it starts to just look more like sideways consolidation. That's what I think. That's what I always think when we're going below and then back up above moving averages. Moving averages should provide resistance in downtrends, and they should provide support in uptrends. And so when you're trending above the moving averages, you're clearly in an uptrend. When you're trending below the moving averages, you're clearly in a downtrend. When you start moving up and, above, below, there's just no trend. It's a trendless environment. So that's part of what I'll be looking for as we move forward here. S&P 500. There's your breakout to an all-time high. We had the prior highs that you can see back in March, maybe even early April right here. Pulled back. April was the period where we got a little bit of a sell-off. I thought maybe in March we would see 3 to 5%. We ended up getting probably about 6%, but we got it in April instead of March. But we've rallied right back, which is what I've expected. I think we're going to probably continue to see a pretty strong rally. We'll have pullbacks along the way. Watch that rising 20-day moving average. A 2% pullback at any time is possible because right now we're trading about 2% above the 20-day moving average. But we now have the 50-day going up. We have the golden cross with the 20 coming above the 50, rising, and we have price action rising with all-time record highs being set almost daily. And the VIX down, like I said, at its lowest level in a year, closing at 1186 yesterday. All of this bodes to me like we're going higher. Pullback should hold the rising 20-day moving average, but look for higher prices, at least in the foreseeable future. Moving on to the NASDAQ 100, very similar looking chart here. Again, March, April set high. Well, mostly March on the NASDAQ 100. Then we moved into April. You can see some pretty big selling here. I don't know what we ended up going down, maybe 7 or 8%, something like that from top to bottom, probably 8%. Anyway, we've come right back up. Look nice now. Seeing a lot of hollow candles. We don't see hardly any red-filled candles this month. So again, how about that go away in May? Talked about that quite a bit going into May and then since May. May through August, best time of the year for growth stocks. Now, we don't normally see huge advances, and we certainly don't normally see May moving higher from the 6th to the 25th, which I pointed out as well earlier this month. But it's a tendency. And as I pointed out, the annualized return from the 6th to the 25th is minus 12% since 1950. So that's annualized. So that would be taking, 3 weeks and then blowing it up, and it would come up to minus 12%. So 3 weeks, that's what, 1/17 of the year. So take 12% and divide it by 17, and you get about 2/3 of 1%. That would be roughly what you would expect. On average, that's the tendency from May 5th close to May 25th close. So 2/3 of 1% on this index would probably be like 120 points. So what we would normally expect is maybe on May 5th, I don't know where we were here. That's May 6th. So maybe from here, we would normally expect just to kind of go sideways and maybe slightly lower. Well, it doesn't happen that way every single year. That's the average. So maybe this year's the strong year. Maybe next year's going to be the one where we drop 5% and bring it back down to average. It's not like every year it's going to be weak. And I'm just commenting on that because I think sometimes the historical tendencies is taken literally, like I'm calling the market. I'm not calling the market to go lower. I'm just pointing out a tendency. So it's a risk. If you're on the long side, it's one of the risks you're taking. Anyway, solid action right now. NASDAQ continuing like the S&P to set new highs. And again, not much in the way of filled candles, which I think is very encouraging. IWM small caps. This is the weak link. You can see we haven't cleared where we were at the high back at the end of March. Still got some work to do there, but off of the longer term trend higher all the way to this high, potentially this could be a cup. Although, as I mentioned earlier, I would have liked to have seen the right side get up to about 211. 210.77 was the high candle body over here. And so all we got up to was almost 210. But still, most, I think, would recognize this and think cup handle. And if you're not thinking that, like I said, there's a fairly straight up move, which would be a flagpole. And then you've got the flag here. A breakout above that would be very bullish. So the pattern is bullish, even if we haven't quite made the breakout like we have on the S&P 500 and on the NASDAQ. Transports, not much I can say here. This is one of the areas, again, if you're putting all of the check marks in the bullish column and in the bearish column, this one absolutely goes with a big, bold check mark in the bearish column. Transports are not performing well. Even on the way up, I talked about this. We didn't really see those big hollow candles. Here we had big hollow candles, but on the way up here, it was mostly gaps and failures. So yeah, we were moving higher, but it just didn't have a good feel to it. And then right back down we go. 15.4, which was our big support over here, prior to getting down to 15.2, which I thought was our biggest support. And yesterday, literally, we took out both of them on one candle. Not good action. Moving on to the chart of the day. For those of you that are interested in the chart of the day, you need to go over to earningsbeats.com. That's my home. Earningsbeats.com. Both are plural. And when you come over, certainly can check out our service. Start your no-cost trial. It's a great time to do so because we're running our absolute best deal of the year. So come in for free, check it out. And if you like it, you'll be able to extend using our best deal of the entire year. So great time to check out our whole service. But if you just want to see how we approach the market and just get a feel for our strategies and the way we approach everything, you'll want to subscribe to the EB Digest. This is completely free, no credit card required. Name and email address, hit that subscribe button, and you'll be able to check out these EB Digest 3 times a week, Mondays, Wednesdays, Fridays. Normally, we try to get these out around 8:30 in the morning. Try to get it out before the market opens so that you have a chance to look at it and digest it. But I think it's a great way to get to know us. And I think it'll add on to your own trading arsenal. I would expect that there's going to be some nuggets of education, research in here that I think is going to be valuable in your trading. So make sure you check that out. Sign up there. By the way, we have tens of thousands of folks that have signed up into our EB Digest. So, and it makes sense. I spend time on it. It's not just here's a couple minutes, let me just throw something together. I spend time and I try to put some pretty good charts out there to indicate, again, the things that we look at Earnings Beats, possible trade candidates. Sometimes I'll look at sentiment. I'll look at things outside of individual trades for educational purposes, but make sure you check that out. All right, so today's chart of the day. This is really a poster child on the way I like to trade stocks. I love to swing trade. This, last few years has not been great, in my opinion, for swing trading because I just think coming out of the pandemic, we've had inflation issues, threats, and then we come back down. All of a sudden we'll get some good news and rates will start to come back down. Then they take back off again. And I think it's just led to a lot of whipsaw rotation. And when you swing trade, you're looking to catch something that's just starting for a while. And a lot of times it just doesn't allow you to move up and capture a nice swing trade before things start to flip. I do think things are beginning to get better in that regard, but I still don't think we're all the way there. But let me explain what I like to see in these charts. So I'm going to annotate first. I'm going to come over here and I'm going to zero in because this is exactly what I want to see. Earnings. So earnings come out. We have a big volume day. We have a big gap up because they come out with numbers that are above expectations. And then normally what happens when a stock gaps up, market makers are on the other side, so they're shorting. And the expectation then is after you gap up, that's one of the reasons why I will not buy on the gap. I need to wait because I want to see if I like the stock and I buy it on the gap and it goes back and fills the gap. In this case, I would have been down probably 7 or 8% from the very get-go. So I don't like to chase because you don't know which way they're going to go. I sit back and I evaluate the strength depending on which way they do go. In this case, big gap up, market makers are on the short side, but the market makers can't get control of the action. The stock comes down, tests an intraday low, which by the way, I would mark that as another support level. So here is the support level from where you open. Market makers, they set the opening price. This is where they set it. So to me, that's kind of a key level, whether you're going up or down. Eventually, it's going to be a key level one way or the other. But here, we gap up, market makers jump in on the short side, and we keep going up. And the volume for the next 3 days, the day of earnings and the next 2 days, remains pretty strong. You can see here the second day we came back down, came all the way back up, finished at the high. Third day, down a little bit, back up at the high. This was 3 days in a row of above average volume, all closing at or near highs. That tells me there's a lot of interest in the stock, a lot of buying, a lot of demand, which is important when this happens. When you start coming back down and you get close to these support levels and the volume is much lighter, we were going up on 2.5 million shares, 1.5 million shares, and almost 1 million shares. And these last 3 days, we've come back down on probably 400,000, and whatever yesterday was, 541,000. So we're coming back down on much lower volume, which I think is good in terms of volume trends, price volume trends. And now we're able, instead of jumping in and chasing, now these are considered, what I consider anyway, support levels, and I'm buying at support. If I buy here, I don't know which way I'm going. If I buy here, which effectively is the same price, I do know which way I expect the market to go. Or with the stock to go. I expect it to turn back to the upside. Now, could it go back down to this support level? Sure. Stock can do anything. Could it go down and fill the gap? Absolutely. This is not a guarantee. I wish I had a guaranteed trading strategy for you. I don't have any of those. But this, to me, is a solid reward to risk entry when you come back down and test this zone. If it does go back, you can have your strategy already mapped out. You might say, I'll get 1/3 here, I'll get 1/3 here. And if I'm wrong and it goes all the way back down to gap support, I'll get another third. And that way, if it goes all the way back down to 55 and change, you'll have 3 different entries, which probably would get you into an average somewhere in the 57s, maybe something like that. And then when the stock's at 55, 80 or whatever, 57 entry isn't really that big a deal. And then you can be using, maybe that gap support for your stop. Maybe you give it a little bit more room to the recent low. But that is more conservative strategy. For me, I will be fully in with this stock around probably at this 59 level. I've already entered half my position. And if we go back down and test 59.90 or even just a little above that level, I'll fill out my position. That to me is the most significant support level. I put this one in because intraday, that's where the selling, if the market makers were taking it back down initially, that's where the buyer said, we're not going any lower. And so buying came right back in. So that's why intraday, maybe we see that as a secondary support area. But I love the stock. It is in the medical supplies area, which you can see down here, is basically putting in a double bottom. I'd like to see the relative strength hold on the group here. If we get the entire group to hold and start to bounce, and then you've got LIVN hitting support and as a leader, I would certainly expect movement back to the upside. If you look longer term over the last year, you can see that this gap up actually was above any other candle body on the chart. So market makers took that earnings news and opened the stock above any of its prior resistance in the last year, which again is another bullish sign in my opinion. All right, let's get out of that and move on. I got one more thing I want to show you here. I mean, copper prices have been going crazy. And what I want to do is I'm going to bring up copper. I'm going to show you over the last, well, we'll go back 12 years, which is certainly during the secular bull market. And what I want to show you on this chart is the correlation between copper and the S&P 500. And what you'll see, do you see us spending a lot more time above the zero line? And it's a little easier to see when you highlight trips above 0.50. So if I take this right here, here are all the trips above 0.50, right? And then if I grab that and I drag it back down, here's all the trips below minus 0.50. And take a look at how many times we're up in this blue shaded area and how many times we're in this lower red shaded area. I think it's pretty clear that the price of copper is much, much more positively correlated to the S&P 500 than it is the inverse correlated. So this tells me when copper is doing well, and it makes sense. I love these signals that just make sense. Copper is an industrial metal. You might buy gold because it's a currency and, you're worried about the market or whatever, or maybe you think dollar is going to go lower, whatever it is. That's why you would buy gold. Copper is bought because it's used in construction. And so when copper is going up, to me, I follow copper much more closely than I do gold or silver. Gold, silver, especially gold, is just maybe an alternative to whether I want to be in the S&P 500 or am I really nervous? And if I'm really nervous, that's where I might consider trading gold for a period of time. Copper, though, is telling me, it's giving me another signal about global economic strength. Because when copper goes up, and look at the volume, by the way, that's been coming into copper. And you can see the correlation right now is turned back up into this positive area. Copper is moving up. It's breaking out to, I believe, I know it's a long-term high. I don't know. Let me see if we can go back here. Actually, we'll just get out of this. But just note that we're breaking out on copper here. And we could go back. Let's go 30 years. I mean, copper right now is making its highest move. It's already breaking out to its highest level in 30 years. So start putting all these signals together when you think about the stock market and which way it's going to go. I know some people are saying, wow, what's going on with utilities? Because look at sentiment. Look at copper. Look at the growth versus value, the long-term relationship, which continues to go up. Look at divergences. Divergences on the weekly charts are perfect right now. Back in 2021, they were all negative. Every time the market went up, we saw the weekly PPO go lower. You've got to take signals all together. You can't just pick out one and say, well, you said 2 years ago that when this happened, the market was going to go down. Well, yeah, but it was in connection with all those other things and with the big one being sentiment. And everything I see with sentiment right now tells me market's going higher. So, if you want to short the market, listen, everybody can make their own choice. I just come on here and give you my opinion. But my opinion is that these signals are overwhelmingly bullish. And if you want to fight it, feel free. You're more than welcome. Maybe it'll turn out the market goes lower. I just don't think it's going to. I think we keep going higher. And we'll see who's right and who's wrong and which way it ends up going. I know I've been bullish since the middle of June of 2022, and I think that's certainly been the right side of the trade, and I continue to be bullish. If you like the way we look at the market, please make sure you hit that like button and subscribe to our channel. It will really help us out on YouTube to get that, help with the algorithms and everything to try and help build our community. So even if you're not a member, or even if you can't afford membership, you can certainly still help us by clicking that like button and also subscribing to our channel. Anyway, that's it for me. Have a great day, everybody, and get set, buckle up. NVIDIA coming out after the bell. Happy trading.